Hello and welcome to Fundu Money. Here we will discuss how volatility, that's prices of stocks and other securities going up and down rapidly in any particular market or in their respective market, actually how it helps investors. So how volatility helps investors, that is something that we're going to discuss, and it is important for you to realize why and how it helps you, because volatility, as any experienced investor or market expert will tell you, is a fact of life when you're investing, and the smarter you are in managing volatility, the better investor you become. So this discussion is obviously not meant for traders. We're talking investors who are investing, making the money grow for a particular financial goal. And before we give you some of the reasons why, or the ways in which volatility helps investors, the idea is to give you a background. Typically, when markets are going up and down rapidly, there's a lot of movement in the prices of shares. Typically, that's where prices move up and down very rapidly. It's not uncommon, rather it's very common for investors to feel jittery, panicky, and they often end up taking wrong decisions. They end up taking decisions that hurt them. They become fearful. But the truth is, which you obviously need to be aware of, that in the market prices are going up and down at every moment. So it is only during certain periods of time when they come into focus, they come into the notice of investors, and that's when they, if they don't handle it well, they can do things that can hurt them. So basically, volatility is there. Prices are moving up and down all the time, but when it's extreme, it's very pronounced. Rapid price movements upwards or downwards is happening in a very short period of time. That's when you're feeling, as an investor, you start feeling anxious. It unsettles investors, and of course that if you have investment plans, they're typically thrown out of gear. So the idea is how you can, if you understand it better, then of course you can be a more successful investor. So some of the things that experts will tell you is the reason why volatility ends up playing a very important role, especially when markets are moving downwards, or they've really run up very fast, as they have in the past past many months. That's when any downward movement does cause a little bit of a jitteriness, even if there's a rebound. And the famous lines in some textbooks line is as follows: that the pain of loss tends to be much more than the joy of gain. So you are more scared of losing money rather than the joy that you get from gaining money, if you have to compare both of them. So fear is a more a powerful emotion, and therefore that explains to a great extent some of the knee-jerk and other reactions people come up with when there's extreme volatility. So having said this, volatility plays a very important role in helping you as an investor. It helps you towards your target of achieving your financial goals, things that you want to do with your money by making them grow. So this is something that we will be discussing in the next section. We'll give you three reasons or three ways in which volatility actually helps you as an investor. So those are very important for you to understand, so that then you can figure out what are the various ways. But first, if you can understand at least these three aspects, then you can become a much better investor, especially in times like this. So we'll be back shortly. We'll be giving you those three important ways, or three important reasons, or three important ways in which volatility helps you. Don't go away. Welcome back. Welcome to Fund Money. We are discussing how volatility actually helps investors. Now, it seems counterintuitive, doesn't it? I mean, prices moving up and down in a very pronounced way. How can price movements actually help you make money in the long term? We're talking about long-term gains. We're not talking about short-term gains. We're talking about long-term gains. So, number one is a very predictable thing which mutual fund investors know, which is that volatility actually helps you make cost efficient investments. All right, so how does that happen? Mutual fund investors know that if they invest regularly, say through a systematic investment plan where you're investing a fixed amount of money, say every month, which is typically the case, then in the long term you gain. How does that happen? When the markets are up, you buy lesser number of units. The markets are down, you buy more number of units. So over a period of time, average cost of buying a unit keeps going down, and overall, as the markets go up, which is bound to happen when an economy is growing, you actually gain. So this is the part of cost efficiency which is happening. So what it is basically doing is you're basically automating your investment. So regardless of whether the market is going up or down, you are bound to gain any which way. So you have taken emotion, the fear, which is basically causing nervousness for you, or unsettledness, that's going away. So that's something that helps you as an investor. Now you can do the same thing. You can do the same thing in case of stocks. If there's a stock that's moved up quite a bit, you book some gains fully or partially and invest in another stock where there is long-term value, but it is right now is priced very, very reasonably, and you know you can create a long-term wealth. So you're actually tinkering, you're making sure that average cost, which is happening automatically in systematic investment plan, that you're doing it yourself. But of course you need to be pretty good on an average with stocks. You're basically becoming your own fund manager, right? This is something where cost efficient investments is happening, and because of your cost efficient, therefore you're being able to make your money grow. That's number one. Number two is market volatility actually gives you a signal to fix things, right? So what typically happens is when the markets are going up very rapidly, a lot of people actually end up investing more in high risk investments. So if the stock markets are going up, so they'll end up investing a lot in stocks. So that may be at variance with the comfort level they might be having. So in normal circumstances, they wouldn't have, had the markets been okay, then they hadn't been moving up rapidly, they probably wouldn't have invested so much in equities. But what happens is, because they're getting excited, markets are moving up rapidly, they're ending up taking higher risk than they would have otherwise. So actually volatility helps you correct that imbalance. And of course, when you're correcting it, obviously you're selling something off, or pairing your investment out there, you're obviously looking at opportunity elsewhere. So you could be in stocks, you'll be looking at other undervalued stocks or other capitalization, other themes, or you can actually move on to another asset class. So it could be debt, it could be gold. So what it is doing is it's making you less vulnerable to a risk in a particular asset class. So volatility actually is giving a signal, encouraging you to spread your risk. So when you're seeing, and therefore in the long term, it's making you less vulnerable to certain developments in one particular investment class or one particular asset class. What is the result of this? The result is, because you're always managing your risk, so what's happening is the average return that you're getting every year over a long period of time is becoming more and more stable, and as a result of which you don't have a bad year. So as a result, your you're most likely to achieve your target either on time or before time, right? So this is the second bit. The third bit is higher growth investment. You, for certain goals that you have for retirement, for children's higher education, buying a home, setting up your own business, you need large amounts of money. Now, to raise large amounts of money, save large amounts of money, you have to invest regularly and you have to make them grow. Now, to make them grow well, it is almost inevitable, or rather, shall we say, it's inevitable that you have to take go into higher growth investments. These also they turn out to be high risk investments, so they are also volatile. So if equities give you pretty high return, long term high returns, they're also volatile, right? So if there is any other investment that's going to give you high return, you will find that it'll see its prices move up and down quite a bit, right? So more volatile the investment, more the chances of it being delivering high growth to you. So but that is the other flip side is, more volatile it is, the chances of you making a loss is that much. So therefore the trick is that you figure out what is the ideal time period you need to stay invested, and of course you have to look at that individual investment. So in equities you need to be invested for the long term. At the same time you need to also see what kind of a mix or individual equity investments you're doing. So some of the major reasons why volatility happens in equities are because of company developments, international and domestic economic developments. There could be political events, policy changes. So those are some of the reasons why volatility happens in equities. So stock market, any news happens in these particular areas, you'll find there are obviously company developments, etc. It's financials, financial data coming out, announcements happening. So these are the reasons why stock market or stocks, individual stocks get affected, and their prices can move up rapidly up or down. At the same time, you would also find volatility in debt investments. So that could be because of interest rate movement. Suddenly the interest rate moved up or down, and in very short period of time there's information about repayment being at jeopardy. The person who has borrowed the money, or the institution which has borrowed the money, is not being able to pay up, or there is a fear that it won't be able to pay up. There's inflation going up. So these are reinvestments. Is a problem. Liquidity is a problem. You may not be able to get the sell it to liquidate it. So these are some of the risks that can cause volatility in debt investments also. So volatility is pretty much part and parcel of market linked investments. Higher the volatility, greater the chance of you're making a loss. So the key part is how you have to contain this risk, which we will not be talking about, but we are talking about why it is inevitable. If you don't have this volatility, then if you don't get into volatile investments, which are of course high growth investments, you will not be able to get the high returns that you seek to get long term large savings that you need. So by being volatile, by getting into volatile investments, you make sure that you are in a good position, and of course managing the volatility to save large amounts. So what are the key parts of handling volatility? Of course we are not going to get so much into detail. That's not what we are going to talk about. The idea was to tell you how volatility actually helps investors. So the first thing for investors is to focus on financial goals. So when you know if it's a holiday, you'll make sure if it's the holiday next year, you're not going to get into a volatile investment. But if it's a retirement which is 30 years down the line, then it probably makes sense for you to get into reasonably high volatile investment, because you know you'll be able to ride it out. If it's a home that you're going to buy 5 years down the line, you probably have a mix. You'll have a controlled amount of volatility because you want to have a controlled amount of equity or high growth investment. You want a mix of debt and equity. So depending on what your financial goals are, you can make a choice of how much volatility and how much risk. Volatility is, of course, the risk of the return being much away from the mean average return is what we are basically talking about, right? The other thing is, of course, as you mentioned, you need to diversify. You need to have investment in different asset class, different kinds of investments, so that risk volatility from one particular investment doesn't impact you, and you don't have an off year or an off quarter or off a set of 3 years. It's smooth and a reasonably stable overall return that you're getting. So one asset class or one investment doesn't do well, you have others which are helping you and pulling you through, right? Then of course you have to do regular investments, because of obvious reasons. We talked about rupee cost averaging. Even lump sums need to be invested on a regular basis instead of doing it at one go, because then you might just feel the full brunt of market conditions existing at that point of time. And finally, you need credible advice, good informed credible advice, experts who can tell you how to manage sudden bouts of volatility that we have seen, say for instance in 2008 and then in early 2020, we're seeing in 2021. So when you have some smart and qualified people telling you, then apart from you being aware, you can also get the benefit of their expertise. So we hope you found this useful. If you've liked it, hit the like button, share it with others. Till the next time, take very good care of yourself, and goodbye.